Hello everyone. In the series of the discussion on chapter number 3, that was national income and related aggregates, we had discussed about the definition of national income, followed by the difference between the factor income and the transfer income, and who are the residents. So these were some basic concepts again in order to the estimation of national income. Now it's the time that we discuss a couple of more terms which were a part of our definition of the national income. We come to the definition once again of the national income that refers to the money value of all those final goods and services which are produced within the domestic territory of a country by the residents of a country in an accounting year, including NFIA, that is net factor income from abroad. So in this definition, yet we don't know that what is NFIA and what is domestic territory. So one by one, we will discuss both of these terms. The number one is domestic territory. Generally, the people relate the domestic territory with the political territory, or sometimes it is taken as political territory. But let me tell you that political territory is a limited, it has a limited scope, whereas the domestic territory, it is a kind of broader concept as compared to the political territory. One by one, we will see the different components of domestic territory here, and then only we would be able to see that how domestic territory is a wider concept and how the political territory is a narrow concept. Here, let us note that domestic territory or economic territory both are the synonyms to each other. So don't get confused when the question asks you about the domestic territory or the economic territory. Both are same. So number one, what are the components of a domestic territory? There could not be any definition of domestic territory, but we have to see the different components of our domestic territory. And if you sum up those components at the end, then you will find that what is our domestic territory all about. So before jumping to the components, I believe that one question it has to be raised before you all, that domestic territory, there are three things. Those are the people, goods and services, and the capital. Whatever the area in which our own people, our goods and services, and our capital can circulate freely, that all the area will be called our domestic territory. So now you see the components. Number one is our political territory. Political territory means if you want to go out for any excursion or any kind of traveling within the India, you are free to circulate. You are free to roam here and there in India. Not during the quarantine time, but in routine way, we can go anywhere within the India. We are free to move. Other than this, if you want to sell or purchase goods and services within the India, no hassle. Still, we can do so without any hesitation. That the movement of these goods and services are quite free. Free here doesn't mean that we are not talking about the price here. Their movement is quite free. And the third thing is capital. If you want to invest anywhere within the India, again, with all the laws, rules and procedures, you can invest without any obstacles. But can you move freely outside the India? Can you sell the goods and services outside the India in the same way as you are selling or purchasing here within the India? So this is what our political territories are. And number one, that is a political territory that allows all your goods and services, people, capital to move freely. But domestic territory says that these three things, the people, goods and services, and the capital, they can move freely even outside the country. Where? What are those parts? Let us see. So number one is political territory, number one component of the domestic territory. Number two now, there is embassies. You must have heard about the foreign embassies which are located within the India. For example, suppose the American embassy is located in India, Chinese embassy, Russian embassy, Pakistani embassy, Sri Lankan embassy, English embassy, So these are the different MNCs, foreign MNCs, which are located within the India. But are we administering them? These MNCs are not administered by our political territory, or you may say that our own administrators. But the MNCs, Indian MNCs, which are located outside the India, because of course our own MNC cannot be located in India. So Indian MNCs which are located outside the India, in all the countries where we are communicating or we are in touch through the trade, tourism, education, health, with the different for the different purposes. So those countries, they allow to establish our embassies there to let our people communicate and be in touch. So we are the administrators of our Indian embassies which are located outside the India. So here domestic territory is a wider concept. It's a broader concept because it is including those Indian MNCs also which are located outside India, but the political territory cannot do so. Political territory or the geographical territory is limited within the map of your India. So that was the second component. The third one is the oil and natural gas rigs. Oil and natural gas rigs, you will see different establishments in the sea areas. There are different refineries or natural gas rigs which are drilled in the water levels, in the deep water levels, and through which we extract oil and other relative commodities. So those rigs are also are a part of our own domestic territory. Other than it, floating platforms. Floating platforms, basically it's a scientific model. So I advise you to see it once on Google, that how the floating platforms are made from the wood and the other equipments. So those floating platforms which are established within the water areas, again these are our part. These are the part of our domestic territory. And the fifth one is that military establishments. Suppose our military is established, any base is established outside the India even. So that is also a part of our domestic territory. So these are the five components. Number one was your political territory, because whatever you see around in the India, in reference to India, so within the India, whatever we are seeing, that is a part of domestic territory, of course. Second is that embassies, which we have seen that Indian embassies which are located in the rest of the world, that is a part of our domestic territory, whereas foreign embassies which are located within the India, these are not a part of our domestic territory. So that's the biggest one of the very major precautions which we have to keep it in mind. And the third one is that oil and natural gas rigs, whatever the establishments we have done in the sea areas, and that those establishments are also a part of our domestic territory. And the fourth one is floating platforms, and fifth one was that any kind of military establishment, even outside the India. Military establishment, that means our own establishment. Our military is sent for any training or kind of any war practice anywhere outside the India even, or within the India, that will be a part of our domestic territory. So here we, if we sum up these all five components, then we find that this is what the domestic territory is, some steps ahead of our political territory. So wherever we have our administration hold, that will be the part of our domestic territory. This is what we need to keep in mind. So now, once again, we recall our definition. The national income's definition says that it refers to the money value of all those final goods and services which are produced within the domestic territory. So now the thing is quite clear that what is our domestic territory. By the residents of a country in an accounting year. So this is what we do here in the definition of national income, that national income takes the income generated by only the residents of a country within an accounting year. Now the concept was that NFI, including, we say that including NFI also. So what is NFI here? Because once you are limited with this part of definition, that the goods and services, final goods and services which are produced within the domestic territory by the residents or non-residents. That is domestic income. But once you add the net factor income from abroad, that means you are converting your domestic income into the national one. So when in the definition of domestic income we add NFIA, then that becomes simply our national income. So these are the two different ways to look at our income. One is domestic one and the second one is the national one. So what is NFIA now? Net factor income from abroad. This concept was introduced in class 10 as well, if you recall it. NFIA refers to, once you see here that we are talking about the factor income from abroad, net factor income from abroad. That means whatever the factor income is earned by our residents outside our country, yeah, from rest of the world, that is the part of our national income. And whatever the income is or factor payments are made to the non-residents who have earned the income inside the India, inside our domestic territory, that is not a part of our national income. We are reducing that. In domestic income, you will definitely add the income generated by the residents or non-residents within the domestic territory. But in the concept of national income, we have to, once we add the NFIA here, that means we are adding the factor income generated by our residents from rest of the world, and we are deducting the factor payments made to the non-residents which have earned the income within our domestic territory. So in the concept of national income, NFIA refers to factor income from abroad minus factor income to abroad. I think it makes a sense now. So the concept of national income is quite clear as far as the definition is concerned. Now our next concept is, how do we convert the domestic income into the national one? It is quite simple. I told you that once you add the domestic NFIA into the domestic income, then it becomes our national income. So what is our domestic income? That it refers to the money value of all the fine goods and services which are produced by the our residents or non-residents within a domestic territory in an accounting year. That is our domestic income. And if you add NFIA here, then that becomes our national income. So that is the number one golden rule, and I suggest you to write here 3 golden rules, among which the number one is the basis of NFIA. Number one golden rule, please note it in your notebooks, that basis of NFIA, number one golden rule, that on the basis of NFIA we convert the domestic income into the national income. So national income is equal to, write the formula here, domestic income is equal to, you can write national income minus NFIA, or you can write that national income is equal to domestic income plus NFIA. So these are the equations what we can frame. So this is the number one golden rule. Number two, now here the thing is that national income can be calculated at a market price. It can also be calculated at factor cost. What is market price and what is factor cost? Let us see here. Factor cost means what? Because we know that the producer sector, it hires the factors of production from the household sector, because household sector is the owner of factors of production. So producer sector, when it hires or when it purchases the factors of production from the household sector, then it has to make the factor payments. So whatever the expenditure is done in form of factor payments, that is our factor cost. So if we are calculating our national income on the basis of expenditure made on the factors of production, that means we are calculating our national income at factor cost. Now expenditure is not limited up to the factor cost only. You see here, even after settling all the payments to the factors of production, now if we here add government sector also, yet we were talking about two sector economic model, where we had seen real flow and money flow between the household sector and the producer sector. But in case if we are adding government sector also, so now government charges taxes on the production of goods and services. So if we add a tax on our factor cost, suppose your factor cost was rupees 100, and in case government imposes 12% GST on that, so it becomes now 100 plus 12, that is 112. So definitely it adds in our expenditure, and this is what the market price is. Once we add the taxes in our factor cost, it turns into the market price. But the story doesn't end here, because the government also provides subsidies to the producers. And what is the role of subsidy? By obtaining subsidy from the government, the producer sector is able to reduce the cost, because it is just kind of an aid to the producer sector by the government in order to increase the production of related commodities. So subsidies, when it is offered by the government to the producer sector, then it overall reduces the cost. So these adjustments if we make in factor cost, then we come to the market price. So that means what? Factor cost plus, if you want to see the market price, then market price is equal to factor cost plus taxes. We are adding the taxes because taxes increase our cost, so that's why we are adding them, minus subsidies. So subsidies are reducing our cost, that's why we are deducting them from the factor cost. So this is how we come to the market price. This is the determination of market price. So market price is equal to factor cost plus taxes minus subsidies. Here let us note that the taxes minus subsidies, if you see it separately, then it is nothing but your net indirect taxes. There is a formula of net indirect taxes, that is taxes minus subsidies. So taxes minus subsidies, in one term we can call it net indirect taxes. When we reduce the subsidies from taxes, then that becomes our net indirect taxes. So here we can also write that market price is equal to factor cost plus net indirect taxes. So that was the second rule. Now the third golden rule, basis of depreciation. How to convert our gross income into the net income, because you might have heard about GDP. GDP means it is gross domestic product or gross domestic income. The domestic product or domestic income both are synonym to each other. So gross, if you want to convert it into now net, if you want to call it or if you want to calculate NDP here, that is net domestic product or net domestic income, then you have to consider the depreciation. Concept of depreciation was already taught to you. So when you charge depreciation on the eligible assets in the entire economy, then it becomes a net product. So net domestic product is equal to your net domestic income, net national income, that is equal to gross income minus depreciation. So net income, that is equal to gross income minus depreciation. I hope that you are writing these golden rules simultaneously. It's very important, because without these golden rules you won't be able to calculate a single aggregate which we are discussing further. So make sure that you write these three golden rules. Number one was that on the basis of NFIA, we convert our domestic income into the national income. So national income is equal to domestic income plus NFIA. Rule number two, golden rule number two, that was on the basis of net indirect taxes. So we converted our factor cost into the market price. Market price is equal to factor cost plus taxes minus subsidies, or market price is equal to the factor cost plus net indirect taxes. So, and rule number three now, on the basis of depreciation, we convert our gross income into the net income. So this is what our today's discussion is, and on the basis of three golden rules, now we are able to convert our domestic income or our national income in different aggregates. Thank you.